Hey, this is Sasha, and welcome to another episode on Hungry for Returns. And this is where we go ahead and answer your trading or investing questions. Now, I may not know everything, but I'll give you my own personal take and insight from the experience that I have. So in this week's episode, we're going to take a look at NVIDIA, looking at selling option premium, selling short-term option calls, and buying long-term leaps ahead of that for protection. So if you have a trading or investing questions, be sure to write us on our website, tradersfly.com, or reach out to us and submit a voice question where you can actually get heard here on the show. All right, so let's take a listen here and get into our Q&A session.
Hi, Sasha. My name is Ian, and I love to watch your videos. I would appreciate if you could explain how to interpret the analyzed trade graph when writing individual short-term calls against long-term leaps. Specifically, I'm interested in understanding the Greeks and the graph for the trade of in-the-money NVIDIA leaps of 240 for 21st June 2019. They cost about $49.90 today. And then writing short-term calls at 290 for 9th November, which gets me a credit of $2.60. So it would be great if you could explain how the Greeks move. Also, any tips on how the brokerage would handle this trade in case it gets exercised? Thanks again, and really appreciate all your videos. Appreciate it.
Okay, so if we take a look at this, really this question was submitted a week or so ago. So when looking at this, right now we have this about 24 days out. If we look at the option premium, probably by the time when it was submitted, it was about 30, 40 days out in the option contract. So what we're looking to do is basically sell some of these, or in other words, the November 9s, and buy some over here June for protection, way further out. So what you're really doing is, you're selling some and you're buying some, but you're buying volatility, right? Because you're buying more time premium. So that's the one thing you have to be careful of. If you did it all in the same month, let's say you sell one put and you buy another one further out, that would be in the same month, so then you're short volatility. That would be kind of like a vertical. But in this case, we're going to go further out for our protection. So we sell the near month and we buy the further out month for protection. So here's what we do. If we did the November 9th here, it would be the 240s right here. The 240s were the ones we talked about that are in the money. You could go to the 230s, whatever the case may be. It's just a matter of how much risk you want to take on. And I'll show you the difference here in a minute. And if you take a look here at, let's see here, if you go in on about, here's the June 19th, we go 248 days out, then you're buying one of these for protection. So that way, in case there's an issue that happens, well, you got one for protection. All this really does is it cuts down your margin a bit. So let's take a look here at NVIDIA. I already have this set up. So let's look at the single alone when we sell one. So the whole point of buying one for protection is so that you don't get margined out a whole bunch in your brokerage platform and you don't have that risk. So this is what you're doing, is you're selling one for protection, and this has unlimited risk, and it really does, because if NVIDIA goes to 1 million, well, you got some problems. So what you're doing is you're selling this for, let's go to the 240. Okay, we're in the money. Okay, so here we're in the money, and let's just go just slightly. I mean, you could even do this on the puts if you want. It doesn't make too much of a difference. The spread will be kind of similar, but I'll show you here what you're really doing. But let's stick to the calls just to make things easier for the beginning. So you're selling the 240. You could sell the 250. Doesn't matter. I'll show you how this works here in a second. So really just a matter of how much risk. So first you're selling one, right? You're selling one option contract, which basically means you want the stock in theory to kind of go down, okay? But that's the near month. The long term then, you're buying one and then you want the stock to go up. And the whole point of getting this is really for protection. Okay, so your protection is actually for things to go up. But the one that you're actually selling premium on, you want the stock to go down. Okay, so the way that this looks, okay, so here's your stock price. Okay, stock goes down, you make money. Stock stands still, you make money. Stock goes up a little bit, you make money. If it continues to go up a lot, that's where you have problems, and that's why you have to buy one for protection. So here in this case, I'm making $625 because that's the premium I'm selling at the 250. Now you buy one for protection right here, which costs you about $2,940, and you got a time decay problem of about $6.78 per day. Now the one that you're selling, you're making $19 a day. So let's say you're making $19 a day, but you're losing $6 a day on premium. So what do you have left? Combining them, you get about $12 a day. So if I combine these, this is the kind of the curve that I get, okay? And as you can see, I'm positive vega, positive volatility. So if this goes down, this tent actually gets a little bigger. Now, what you're really doing here, in theory, if you watch the previous episode, I believe it is episode number 10, where we're kind of creating a covered call alternative. This is really a diagonal, and we're creating a covered call alternative. So what's happening here is, let's say I go to the 245 or the 235 for my protection. You can see how this will actually start looking. Let's say I go to the 200, like a covered call, right? So this part would be my stock, and then here's the call that I'm kind of selling. I'm capping my winnings. So that's really what you're doing in this situation. Now you're buying your protection way further out, and I would only really do this with stocks you're really comfortable with kind of holding for a long time. Now, what could happen here is, let's say the first month, this starts to go down. Now I have the 200 and the 250. Otherwise, if I did the same ones, it kind of more is more of a calendar spread, right? A long-term calendar spread where you're getting a bigger theta, but you have a huge vega position. So that could be a little bit of a volatility problem. But let's say you go kind of in the, you could go 200, you're just rotating it. That's all you're really doing, 200 and let's say the 260, okay? So now, in theory, it's kind of like having a stock. So there's your stock position, and then you're capping it right there with selling your covered call with less margin. And I'll show you why this looks exactly like a stock position here, just real quick. Let's just analyze the trade. Here we'll go down to 100 shares, and then I'll go ahead and sell one. Let's just do the 31 days as the example. We'll sell a single here. Analyze the trade. So here we have 100 shares of stock, and I'm selling one premium option contract. So you could see there's my stock, and then I'm capping with selling one right there. So without it, there's the stock position, right? Without selling the call. And then when I sell the call, boom, I cap my position. And if you do this strategy, let's say we go ahead and we sell one in the front month, and then I go ahead and buy for protection. Well, it looks very similar now, doesn't it? Okay, so the big difference is, of course, this requires less capital. So as we do this and we go for it, okay, here's kind of the issue that happens. Well, if this continues to go down, well, you're down about, let's say, $800, then you do this position again, then you do this position again. Now, you have this protection there, but you could have a volatility vega problem when this happens. So let's say you got the 200s for protection, that's fine. But the 260s were sold, you didn't make any money on them. Let's say then at this point you might sell the 240s, 220s. And then again, you might not make any money on them. So, but maybe by month 3 and 4, then okay, the stock continues to head up. Month 3 you do this, month 4 you do this, so you keep selling premium. And that's really the whole goal behind this strategy, is picking stocks that you're looking to hold for many months, because you're looking to do this kind of month after month by holding that single call there. Now, when you hold that single call, there's no issues and problems against this single call, right? There's no problems with just holding the call, because you could just let this expire. The issue comes with more of this one that you're selling, because if this gets kind of in the money, of course, you could have a little bit of exercising problem with this. But otherwise, you know, once this comes into the last 10, 15 days, okay, you could just get out of this and put the next one on, right? You could get out of it and put the next one on. And that's really what you're doing with this strategy, is you're looking to sell premium every month so that, you know, that's, as that stock continues to head higher, you're just consistently churning month after month. I wouldn't go as far out in time. I mean, you know, it depends on the volatility, but that's just a personal preference. The reason is just you have a higher vega risk If volatility contracts, you could have a little bit of a problem. But other than that, I mean, you go 6 months out and then you could reset the position again. So let's say instead of here you got the November 9 and June, you could just go, let's say December, which might be here. And just also it's cheaper, right? You could go December, 66 days, or even January, which is not as far right there. And it just costs you a lot less. And that might be a nice alternative to this. So you could do this, and then let's just say you get 30 days away from January or so, you do this for 2 months, then you could reset the position again and go about 90 days, 30 and 90 days, and then again as the later month gets to maybe 30 days, you go ahead and reset it again. So anyways, it's just a different way of thinking about it, using a little less capital. But if you want to go further out, I mean, you can. It's just understand that, take a look at this position. You're getting with a Vega of 15. If I go further out, I got a Vega of 43 and a Theta of 8. Okay, versus a December one, you got a Vega of 8 only. Now, remember that Theta and time decay is a little bit quicker, but the Vega to Theta ratio, let's say here it's 2 to 1, 2.3 to 1, whereas over here, if I go ahead and go in a further out month, you have almost a 7 times bigger Vega, 6 times bigger Vega. So that could be a bigger problem. It takes you 6 more days to make up a 1% volatility problem. So be careful with that. But other than that, I mean, yeah, you could do this strategy and you could do it month after month. And, it's just really the same exact thing. Technically, if you buy a stock and sell covered rights against it, it's just you're using less capital. Because if you look at the risk analysis, you're capping your wins, which we know stocks don't usually go up forever and explode that quickly. But you're doing the same thing over here. You're kind of capping it. This has a little bit of a slope, but not too bad and not a big deal. And of course, you could go ahead and, let's just say we rotate it a little bit. If you really want, you could go ahead and rotate that a little bit if you like to, for that kind of graph, but I don't think it makes that much of a difference. Anyways, I hope that makes a little more sense. Go ahead and reference back to the other episode on episode 10, and that should also give you a little more insight on this kind of strategy. It's really, you're technically buying stock and selling a single in option, but you're doing it across multiple months and you're doing it only in options. In other words, it's kind of like a covered call strategy. But technically, if you're doing it on the same strike, let's just say we go to the 240 and we go to the 240 right here, okay, you're really doing a long-term calendar. So that's kind of what you're really doing. And you could do this, but the issue is if it's right at the money or in the money, normally for these longer term trades, you may even want to go a little further out of the money, let's say 250 and 250, because you're looking for this stock to actually appreciate, right? You're looking for that stock to actually appreciate with time. So anyways, it just depends how you set up the trade and what you're looking to do with it, but I hope that makes a little more insight. All right, so thanks for joining me in this video. I hope you found it helpful and insightful to answering your question. And if you did and you want to sign up and submit your own question, then do so by clicking the link over here or going to our website at tradersfly.com and submitting your voice question or even a question by email, and you might be featured on the show. Thanks for joining me, and I'll see you in the next episode.